Here is a number that should make you sit up. 59%. That is the probability traders now attach to the U.S. Federal Reserve raising interest rates at its meeting on the 15th and 16th of September. A day earlier it was 67%. That 8-point shift, in a single trading session, is why gold has climbed to a one-month high this Wednesday, the 5th of August 2026, holding comfortably above $4,050 an ounce. Remember, gold pays you no interest at all. So when markets believe rates are heading higher, the metal usually suffers, because cash starts to look more attractive. What we are watching right now is that expectation quietly unwinding, and gold pushing straight up through it. So what actually changed? Iran. Reports of an interim deal to reopen the Strait of Hormuz, the narrow shipping channel through which a huge share of the world's seaborne oil passes, have transformed the inflation picture almost overnight. Oil crashed by roughly 7% on those diplomacy headlines. Now follow the chain carefully, because this is the entire story. Cheaper crude means cheaper petrol, cheaper freight, cheaper everything that moves. That cools expected inflation. Cooler inflation removes the Fed's main reason to hike. And a less aggressive Fed softens the dollar, which makes dollar-priced gold cheaper for anyone buying in sterling, euros, or yen. That is how a peace headline in the Gulf ends up as a green candle on a gold chart. The effects are already visible across every asset class. The Dow Jones surged around 1,100 points on hopes of an off-ramp from the conflict, and both the Dow and the S&P 500 closed at record highs as war risk was priced out. Gold, meanwhile, is on track for its first monthly gain in 5 months, which tells you just how punishing the preceding stretch of higher for longer rates had been for the metal. For households here in Britain, the mechanism is refreshingly simple. Lower crude feeds through to forecourt prices and to the cost of imported goods within weeks, not years. And a softer dollar tends to lift the pound, trimming the price of nearly everything we buy from abroad. Where does this go from here? Be careful, because this rally rests on a rumor, not a signature. An interim arrangement is not a treaty, and the Strait of Hormuz has a long history of headlines that reverse within days. Watch 3 things. First, upcoming U.S. jobs data, because a hot labor market revives the hike case and pulls gold straight back down. Second, whether the deal is formally confirmed, because gold is currently being paid twice, once as a safe haven and once on falling rate expectations. If peace genuinely holds, that safe haven premium drains away even while the rate story still helps. Third, the September Fed meeting itself, now the single biggest scheduled risk on the calendar. So here is the point worth remembering. Gold is not rising because the world became more dangerous. It is rising because the world looks a little less dangerous, and that is genuinely unusual. The driver today is the interest rate path, not fear. That makes this move more fragile than it appears, because it depends on one number, the odds of a September hike, continuing to fall. If you are holding gold this morning, you are effectively betting the Fed stands still. Keep one eye on the oil price, because it has been leading the gold chart, not following it.